fund performance in 23, markets in general, and not to forget budget or interim budget 2024. Welcome to the show, Devina.
Hi, thanks, Kshitij, for having me.
Thank you so much for being part of the segment. Now, let's start with the performance of the First Global Fund. Now, it has delivered over 30% return in 23 compared to what 21% seen for Nifty 50 in the same period. Take us through the numbers as well.
Okay, so actually, then I think we shared the numbers little before this end of the year. So we ended the year at 33.7% up, so almost 34% up
Oh, okay.
versus the Nifty, which was just over 21%. So
Okay.
it's been a good year. And this, remember, I mean, we very strictly limit our exposure to micro caps and small caps. I mean, below 1,000 crores, we don't even look at it. And even below
Hmm, hmm.
5,000 crores, we'll rarely be above 15 to 20%. And that 5,000 crores is also only a one cutoff. We also very strictly monitor liquidity. So even stocks which look good, where we are not sure that we can exit
Right.
in volume, we will not enter. So with all those risk management things in place, we still manage to deliver what I think is pretty good results. And
Absolutely.
since we started, now we are getting close to about 4 years. Next month will be 4 years. And so that's been a good run as well. So I think if we'll talk about it now or later, whatever.
Absolutely. No, no, we'll discuss that. We'll discuss that in detail. Now, let's start with the year. Now, in fact, the year 24, has started on a strong note with the benchmark indices hitting fresh record highs, Sensex, about 73,000, Nifty 50, 22,000. But do you think the momentum will continue as we brace political and global volatility in the year ahead?
So January actually has been, by recent standards, somewhat volatile. So you did see a correction and then a run up,
Yeah.
etc. But if you look at, I mean, there is no point trying to predict short-term movements.
Hmm.
And in fact, I never give a year's target either for the indices. But
True.
if you look at our outlook for the year, that remains positive. And the reason for that is really long-term data. It is not just what happened in 1 month or 3 months. It
Mhm.
is, if you look at the markets, the Indian markets, if you look at the mainline indices, Nifty and Sensex, etc., 2000 to 10 to 20, there was a full decade of very much
Hmm.
below par performance from the equity markets. So
Right.
we have this thing in mind that Indian equity markets give you 15, 16% return with some volatility. But
Hmm.
what people don't realize is that the volatility can be quite tremendous, not just from 1 year to the other, but whole decades. So
Oh.
2010, if you had invested 100 rupees, in 10 years, you
Hmm.
would have got only 230 rupees. Whereas in
Ah.
fixed deposits
Okay.
alone, you could have made 190, 200. So it barely gave you any returns for the risk of being in equity markets. And contrast that with, let's say, 1980. If you had invested 100
Right.
rupees in 10 years, that would have become 700. So that was the contrast, and that created the room for markets to go up. So, once that thing turned, I was quite certain that you will see a period of
Hmm.
outperformance relative to the globe, because that 2010 to 20, you were very much below what global returns were. In fact, in dollar terms, you didn't make any returns at all. At a time when
Hmm.
the
Hmm.
US
Hmm.
in that decade compounded 11.5% in dollar terms, India gave
Hmm.
no dollar returns at all. I think it was marginally negative or marginally positive. It was just about zero.
Uh-huh.
And so that created the room. And so the risk of a crash, I mean, coming back to the question, is when you are far
Hmm.
above the
Hmm.
trend line, you are not even at the trend line. So in
Okay.
that scenario, I mean, you might think there's some volatility. For example, a few weeks ago, we bought hedges for about half our PMS scheme, because, that's
Oh,
part of our risk management, that whenever we see there's some uncertainty, even though there's
right.
not a big risk of a crash, we buy some hedges. Of course, there's a cost to insurance, so you don't
Hmm.
always buy insurance, but that's the way we manage things. But while there might be some, volatility correction sideways for couple of
Hmm.
months or something like that, we still expect the markets to do well. So whatever is your equity allocation, I never say that you should put 100% of your
Hmm.
money in equity, but whatever is
Hmm.
your equity valuation allocation, you should be in the markets. and at the most you can split it over 2 months or 3 months. But also I find a lot of people say that I will buy it when there is a correction. So for example, this
Yes,
month itself there was a correction,
that's a
but
common
people
tagline.
don't buy it. We had kept some money which had come in aside, and we did invest when that correction came. But I
Right,
don't think
right.
many people do that. So they will keep waiting, it will go down further. And the thing is that the risk is always in, I mean, all of us understand this risk that if you are invested in the markets, we can lose money. But there is a risk to not being invested also. And over a very long term, I'm talking over 40 years, 100 rupees, if you had invested, we did this exercise a little while back, so it would have become 56,000. If you missed out
Right.
just the 10 best days in 40 years, that you would have lost two-thirds of the returns. If you missed out the 30 best days, which is less than a
Mm,
day a year, 90% of your returns are gone. Instead of 56,000, you're sitting at 5,000. So the risk
right.
of missing out the up move, and the up move is always when there is risk, when there is some uncertainty, some
Mm,
volatility. So I mean, the political part that you talked about, I mean, in the ultimately, of course, the probability right now looks only one way, but I'm saying even if there is a
mm,
surprise, as happened in 2004, 20 years ago, there was a big
right.
surprise that NDA was
Mm,
supposed to get the next term, and that didn't happen. And there was a
mm,
massive crash on the day. But soon enough, in a matter of weeks, the market had gotten over it, and that was like on a full year basis, it was, excuse me, one of the better years we had. So
true,
that,
true.
is not something worth spending sleepless nights about.
No, no, absolutely, and well said. And I'm sure our will take note of that. And before I go ahead and move on to my next question, I would request each and everyone who's watching this live stream right now, in case they have any questions, we'll take that question regarding the fund, regarding the investment process, regarding anything that you have in mind related to markets. Do let us know. We'll try and take that up with Devina right here on this live stream. Now, you shared interesting data, Devina, earlier, and about the fund. And so, if someone had invested, let's say, a crore in the PMS in Feb 2020, just before the COVID, it would have become more than 2.57 or 2.5 crores with a lower volatility. So, how the fund can maximize gains and lower volatility?
Okay, yeah. I mean, so if anybody had invested 1 crore, it would have become 1.57. In the index, it would be about 1.8, 1.87 or something like that. So
Uh,
that's the difference. And of course, as you said, with lower volatility, lower drawdowns meaning, any even a temporary loss. So actually, this is a myth that you have to take higher risk in order to get returns. So the way to get returns
right.
really is to have a proper
Mm,
system in place. That is essential, because the game has changed. It is like, India. We all know India. Hockey is India's national game, and why is it
true.
India's national game? Because we used to dominate hockey from the 1930s onwards, India, and then India and Pakistan, right up to the
True.
70s. And then from the
Mm, mm,
70s, we were nowhere on the scene. And why did that happen? Because we went from grass to astroturf to artificial grass. So the skill set
okay.
required changed from very good
Right.
dribbling and stick work. It went to being very fit, very fast, and so on, which
Mm,
Indians were not that good at. So it is something similar has happened in investing, that the playing field has changed, but people are still doing things the way they did it in the 90s. And that is why you see that very few fund managers manage to outperform. Because, see,
mm,
earlier the
mm,
thing was this, that you had an information arbitrage, that when you meet companies, you get some information which is not publicly available. Now, even the
right.
con call transcript, analyst meet, everything is available to everyone. Now, the skill set
True.
is that there is so much data. Who is better at analyzing all this data in a proper
Yeah.
fashion? And in a proper fashion means bias free and noise free. And when
Right.
human judgment comes in, these two things come in. So if you
Mm,
put all your expertise as a human being into a system and use that system, that will do better than you will do as a human being. This is sounds strange, but that is the truth. And I mean, I was on a panel some time back with some fund managers, and they all on
yeah.
their own said, yes, information arbitrage is gone, but you still expect to outperform, which to me is a logical fallacy. because investing has moved also from a winner's game to a loser's game. What does that mean? So, 50 years ago, your grandparents could find stocks which nobody had heard of. Anyway, spreadsheets did not exist. Financial information was not that easily available. So you could find the gems. Now, with all data available to everyone, the smartest people in the world in this market, how are you going to, if you tell yourself that I am this genius who will find everything, yeah, all my calls will go right and no one will find the gems that I have found, I think you're kidding yourself. So the only way to do it is systematically. And first, as I said, from winner's game to loser's game means first you have to ensure that you don't lose big time. So we have a lot of filters in place, including the fact that we remain diversified, not just in terms of number of companies, but across sectors. We don't want to take any outside bets because the first rule in the game is not to lose. And that is why, so in any kind of stress test, whether it was 2022 in the global markets or whether it was the COVID crash or the Russia-Ukraine war, our drawdowns, our losses are lower because our whole system is designed towards managing risk first. And once you manage risk and you have a systematic way of picking stocks, again, people just, sort of copy the headlines. So with diversification, we have done well. So I see some fund managers who always used to say that the portfolio should be concentrated are now saying portfolio should be diversified. But it is not that if you increase the number of stocks, you will get better results. I'll tell you the mathematical basis for having a larger number of stocks. It is simply that whatever is your skill level, by having a more number of stocks, you ensure that your final results are closer to your skill level. I mean, it is in probability terms that the actual value is close to the expected value. So, but you first have to have the skill level. It's just getting the number of stocks is not going to get you the thing. And concentrated portfolios can do well in a phase. I mean, that's the whole point, because then you're relying more on luck than on skill, because investing is a game of luck and skill. We are trying to eliminate too much of the random luck factor and say that our results should be close to our skill level. If you are just playing 12 stocks or 15 stocks, and that too maybe in only 3 industries, you are playing luck, and there will be a phase when those industries will do well and your funds will do well. There will be a phase when they don't do well, which you will see in a number of cases.
Exactly. So, the market moves in cycles, and like you rightly pointed out, that at times these industries will do well when the tide is going higher, and when the tide is going lower, there's a possibility that they might not be able to perform that well. And in fact, good that you raised the point about risk management, and as you rightly pointed out that. You've already initiated some hedges, or at least 50% for the portfolio. So in case something does happen, there is some, insurance in place to cover that. I hope our viewers as well as investors are taking note of these critical things, because all these things are very important when you are doing your own set of portfolio or you're doing diversification. Now, let me also move on to the next big thing, or at least. From a market point of view, the vote on account or the interim budget. So, yes, it is because we are here, we are talking. So, yes, we have to ask you, what are your expectations, from the budget 24? Do you see any big ticket announcements coming in?
Kshitij, I've actually turned down all pre and post budget media requests. But let me tell you, I mean, first of all, of course, vote on account is supposed to be a vote on account and therefore not have big announcements. But if you ask for my wish list, it is not really to do with, I don't know whether your viewers would even be interested in that, in the sense it's not about taxes on corporates or something for the stock market. I think really where you need to focus is the big picture, the long-term picture for the country. And there I would see 3 priorities, and actually they're interlinked: employment, education, and health. Because employment is where we are lagging. We talk of a demographic dividend, But you have people in the working age population, but in a demographic dividend, you have to have people in the working age population into how many people have
Right.
jobs into the productivity. And we are faltering on the second one itself. We don't have jobs for those young people. So that
Right.
is, that to me is the most worrisome bit, because the demographic dividend is there for only a limited number of years before, the population kind of flattens and then starts falling. And so that is one. And related to improve your human capital is education and health. Again, we've
Right.
made a lot
True that.
of noise saying that we will increase spending on these and outcomes on these, but not much has happened. And the COVID has also put you back in both these fronts. So if you don't make it up, then soon enough, you will have another cohort of young people who are not employable, because, their education has not been good enough, and maybe their health also is not good enough. So those are the things where I think focus is needed. Because otherwise, you have 80 crore Indians already who need free rations. So you need to get out of that kind of uh,
Right.
trap.
No, absolutely valid points there, and I hope our government also take note of that, and some provisions could come in, if not in this one, but definitely in the other, or in the next part of it when the elections are over. Now, let's move to the international markets, Devina. How should one go about international investing in 24? Now, we've already seeing some bit of trouble in China, and that is also impacting, and there are other geopolitical concerns as well. So, what will trouble more, interest rates or the slowdown in China?
Okay, see now, 4 years we've had a lot of upheaval, I would say, in international markets, with all the pandemic related news and vaccine, and then lockdown,
Mm,
one lockdown, but another opening. Then after that, the
mm,
interest rate hikes. So then the Russia, Ukraine, and so on. But ultimately, the thing is this now. So I mean, I don't think 2024 is going to be more volatile than what we have seen in the
mm,
recent past.
right.
2022 was like a kind of outlier year. It was actually the worst year. I mean, not in
Mm,
figurative terms, but literal terms, in about over 100 years. Yes, in asset markets, where every asset, every region was down. So when
right.
we started 2023, the consensus was there were four things. That one was that
Mm,
that uh, US will go into a recession, that interest rates
mm,
would be cut in 2023 itself, that you would have China rallying, and generally stock
right.
markets not doing well. And we were on board only with the first one. We also thought that the US would go into a recession. All the other three, we did not
Okay.
agree. I was quite clear that interest rates would not
Mm,
be cut
mm,
in 2023, because once inflation is that high, it doesn't come down in 2-3 quarters. It takes years. Uh,
yes.
we did never made a call on China. We were watching China, yes, that it's going down, so maybe sometime it would
Mm,
bottom out,
mm,
but that never happened. And if you go back to my interviews of a year ago, I had clearly said that it is extremely improbable that 2023 will be a bad year for equity markets. I'm almost certain it will be a good year, simply because 2022 was such a bad year. So
right.
that played out 20. So we were right on
Mm,
3 out of 4. Consensus was wrong
mm,
on all
mm,
four.
right.
And as far as this year, 2023, not this year, last year, 2023 was concerned, the global
Yeah.
markets did well in the index terms. But if you look at US or even the global indices, it was a very narrow rally for especially the
Mm,
first 10 months, when it was only tech. And even if you look at S&P in the US, not only was it tech, but S&P 500 itself, 90% of the move was just 7 stocks, which were
right.
the mega tech stocks, including Tesla.
Mm,
So it was a
mm,
very narrow rally. Now, what has happened in the last 2-3 months is that rally has begun to broaden, which to our mind is a good thing. And
mm,
of course, it's a
right.
good thing for our strategy also, because we are never that
Right.
narrow. I mean, even when you see that it's only those 7 stocks doing well, I mean,
Mm, mm,
we're never going to be in only 7 stocks. So that's a positive sign for global markets, that the rally is broadening.
okay.
Index may or may not do that well, because these mega stocks may not no longer do that well.
Right.
So, but in terms of, like, last year, if you look at S&P, three
Mm,
fourths of the stocks underperformed. So
Okay.
that's why it was a very difficult rally to outperform because it was so narrow. But now it is broadening, which is good for overall markets. China, we are still watching for a bottom, but it is still not. We've not got any signals that it has bottom, and which also let me. I mean, it's a slight aside, but also keep in
Mm,
mind that now it's 15 years plus when China made its high. The
right.
economy has gone up 7 times, but the
Mm.
market is where it
Market
is.
has not.
So yeah, so I mean, like you have to. That's why I mean, you always have to disassociate economies and markets. So I mean, China
Right.
is on its own path. So, but I don't think it will be a big overhang on the markets all over the world. Interest rates, yes, they will get cut. I mean, the people were expecting a cut in
Right.
March, which we were never on board with. But obviously,
Mm,
later in
mm.
the year, you will see some cuts. I mean, we're talking US. Emerging markets already started cutting because they had started
Right.
raising much before India and US did. So,
Mm, mm, mm.
so that I mean, in India, we only think of India and US as the world, but there's a whole big world out there.
No, no, no,
So,
absolutely. In fact, you raised a very important point here, Devina, about the economy and the association with the equity markets. Now, there is some talk, in the circles that yes, the Indian economy is likely to grow at 8 trillion to 10 trillion in, let's say, 5 years or 10 years time, and proportionately, we'll see the stock market also growing about that number. But yes, there are examples when that didn't happen. So so this is actually something which investors should also take a note of. If correct me if I'm not right
yeah, I'd
on
just
that
like to
part.
add something. Kshitij, you asked about international investing. So, I mean, one thing which I would like to leave your viewers with is that that international investing doesn't mean that you go and invest in the US and that is good enough, because
Right.
always the leadership changes within
True.
countries. As I said, that
Mm,
there's the phases when one sector does well. In 2020,
mm,
for instance, FMCG was the flavor of the season. I actually did a
right.
half-an-hour program on saying that just because you think FMCG are stable businesses doesn't mean that they always give returns, because even in the past there have been periods of 10 years and 15 years when Hindustan Lever or Nestle have underperformed. So that was the case. So I mean, so also in markets, that
Mm,
the same geographies don't always outperform. I mean, I'll give
right.
you an example. 2003 to 2007, emerging markets went up 3.5 times. India went up
Mm,
6, 7 times. Brazil went up 10 times. And US was struggling even after that tech crash. They could not come out of it. Let me
right.
remind your
Mm,
viewers that the 2000 high of NASDAQ was not taken
mm,
out till
mm,
2015 for 15 long years. So, I mean,
right.
that 2003 and to 7 is when emerging markets were doing well. You heard all this that US is a has-been economy. Now it is the
Mm,
century of India and China. BRICS was coined. So the
right.
stories always follow whatever is happening in the market. So whichever way the
True.
market goes, you can always find a story to justify it. So we vary of stories, and we always look at the whole world, which is why, I mean, this is a cause for me personally that
Mm,
Indians do not diversify enough globally, which is why
mm,
we
mm,
have a product which starts at $10,000, just less than eight
mm,
and a half lakh rupees, which gives
right.
you all assets, all geographies. Internationally, you will not get a single
Mm,
product which is all geographies, all assets for less
all,
than
yes.
$1 million. This is $10,000. So, I mean, because as I said, this is a cause for me. So, this is something
Mm.
I want Indians to look at, that over a period of time, at least, 30% of your portfolio should be global.
Absolutely, and in fact, that will also create that kind of diversification, which you've been talking about, or Devina has been talking about. So I'm sure investors will take note of that. Now, let me also come to the small and the mid cap space. In fact, do you think the music will continue in 24, or it makes sense to take some profits and allocate to large caps? Now, most of the portfolio, is in small and mid caps, and you rightly pointed out that you have very strict risk management practices in place just to make sure that there are no untoward instances.
Yeah, so I've been cautioning on this space for a while now. So small,
Mm,
particularly small cap, micro cap, this less than 5,000 crore kind of market cap, and also the
right.
IPOs. So
Mm,
that's the risky part of the market. Last year, depending on which index you look at, they are up 45 to 55%, which is a very large number. And a lot of investors are new in the market. They don't have a historical perspective. So let me give you some
Right.
data. So the
Sure.
small cap index made one high in 2008, and then it fell almost 80%, 78% to be exact, over
Okay.
8,
Right.
9. And then it
Mm,
did
mm.
not reach that high till 2016. So, and then again, you had a bull run in that 1.5 years of 17, 18, another
Right.
crash,
Yeah.
almost
Crash
two-thirds,
happened. Yeah. Mm,
65%. And
mm,
so that's the pattern in this part of the markets. And also, let me
mm,
just, this is also, people do not forget their school arithmetic, that percentages are not symmetrical. If something falls 80%, it can go up 5 times and you have made zero return. If something falls two-thirds,
mm,
it will go up, threefold and you are at zero. So I see
mm,
a lot of advisors and fund managers in this space saying, wow, I have made 60% compounded in the last 2 years, when they
mm.
might be the same people who wiped out their investors' wealth in the 1819 crash.
89.
So
Right.
always from that perspective, this is one. But the other thing
Mm,
is that
mm,
this index itself changes 18-20% every year. So that index
okay.
that made that again that new high in 2016 was not the index that went down in 2008. Many of these stocks
Mm,
just disappear.
right.
I mean, today in the Indian stock markets, there are only about 4,000 odd companies that are actively traded. You go back
Mm,
into the
mm,
history in 1990s, there were years when you had 1,000, 1,200 companies getting listed. So
true.
that's the many of them just disappear. That's like
Yeah.
uh, you can you can say they are dead or whatever, and
Yeah.
that's so. Therefore, a lot of companies you have to be, which is why I'm saying
Mm,
on the IPO side also you have to be careful, because
careful.
it is
True.
usually not worth spending that much time or investing money there, because you don't know where you will get allotment, and the only way this thing works is as a portfolio which you can't make beforehand. So be
Mm.
cautious on all the frothy areas in the market. And people are, of
Absolutely.
course, let me just add one more thing. People say that, okay, the index might go down, but I'm choosing my stocks very carefully and they will really do well. So I did that exercise also, that in 2008-9, how many stocks did
Uh,
not go down in that small cap universe? And it was a grand total of
okay.
1%. In
Okay.
1819, only
Okay.
8%. So you are not this
Uh,
genius who will be only in these stocks.
no, no, absolutely. The storification continues, or the storyline continues with every stock, especially the retail investors. Oh, no, let's also pick up a couple of questions that have come up on our chat box now. Ashish wanted to get your view on the sectors for this year. In case you think that some of these sectors are positive now, and Vishaka wanted to understand that what is your take on the PSU banks from a 10-year investment horizon?
Okay, first of all, I mean, what I'm saying now may not hold for the whole year, because the way we do things is that we do a quarterly rebalance from base zero. And the question we ask is that today, if I had cash, where will I be?
Okay.
And because
Right.
otherwise, there is, one of the cognitive biases is endowment bias, that you value something more just because you have it, which is why I say the hold rating itself is a illustration of this bias, because anything which you will not buy today, why will you hold? If there are
Mm,
better alternatives in the market, why will you hold it? So coming back to where we are most overweight, that actually has not changed in now almost 2.5 years, which was industrials and capital goods. Many
mm,
people sort of discovered it in 2023, but we were overweight because our system signaled to so from October 2021. And it had come out of
mm.
being a dog sector for 12 long years. From 2009 to
Right.
21, it was a disaster. So it has done very well. Many stocks went up 2 times, 3 times, 4 times. We have cut down, we have booked profits, but we are still overweight.
Mm.
But now maybe that is tiring. I mean, we have not got a final signal yet, but that we are watching to see whether that rally is tiring. But for now, we are still overweight. Where we added in 2023, and most of them have done well, is auto components, pharma, some construction companies. So we remain overweight on those. Of course, see, everything is not a sector call. Like we were not particularly overweight in IT in 2023, but the best performing stock we have,
Right.
which was up, I think 250% or something, was a mid cap IT company.
Mm, mm,
Or in
mm.
previous years, we've had among our top 5 stocks, ITC and Raymonds, which were not sector calls again. But if you look
Right.
sectorally, this is it. The sector we've not been positive on is banking. But within
Okay.
banking, PSU banks is where we have more of a skew than private sector banks.
Mm,
If you look
mm,
at last 4 years, actually, I mean, most people don't know this data. Banking
mm.
has outperformed only in one year, which is 2022.
Okay. Okay.
And that was the only year when we were market weight to overweight banks.
Mm.
Because at that
Okay.
time the
Mm.
cycle was changing and there was the
Uh,
NPA was behind you, the credit growth was good, and as interest rates
right.
go up, the margins go up for banks. There were a lot of positives, but now I think again this is a sector.
Uh,
I mean, people tell me that you repeat this line in all your interviews that I'm a nervous investor in banks, but that is true. I'm very wary of
uh,
lenders because you don't know where the negative surprises are hiding, and
right.
it's a leverage sector. So, currently our systems don't show that it will do well. So that among the major
Right.
sectors, that would be the major negative call.
In fact, we've seen a couple of red flags as well coming in from RBI for the
Right.
retail, uh, right? And but
Right.
there's another argument which is usually given is the fact that the Indian economy is growing, so the sector which will naturally grow would be the banking and the financial space. Your
This,
verdict on that?
this argument I have heard for banking and infrastructure for decades. That if India
Right.
has to grow, infrastructure has to do well. If India has to do well, banking has to do
Uh,
well. But it doesn't work that way. I remember in I think
but
it
the
was
data doesn't support that
2008, 9.
argument. Huh?
So 8, 9, we had done this whole presentation on how infrastructure companies were making very poor returns, and so that
Mm.
story went fat then. And lenders, I always laugh when people say that this lender is growing so well, and I say, like, how difficult is it to hand out money? It is getting it back that's the problem always. So maybe,
Right.
I mean, I'm an old cynic having seen this cycle too many times, because every decade you have lenders come back in some form. It is sometimes leasing
Ah,
companies, sometimes it is fintech now. So, I mean, in some form it comes back. But as they say,
right.
almost all innovations in finance come to only one thing of increasing leverage in the systems. So that comes back to haunt you.
Yes. So yeah, so there's one argument, but the data doesn't support it in one way or the other. So hopefully, investors will take note of that. Now, we also want to get your outlook on the gold as well as crude oil for the year 24. How are you viewing both these commodities?
Okay. Uh, Again, see, it's not very easy to give a 1 year perspective on this, because there are geopolitical things which affect the price. Also,
Okay.
there are, oil is a cartelized product, so there are also human decisions that affect it. As of now, I mean, to our system, they appear that they'll be range bound, maybe slight bit of upside potential. But I
Mm.
would just like to leave something which is very important, that people think of gold as a relatively safe asset. If you look at
Right.
really long-term history of gold, in dollar
Mm.
terms, the price reached for gold in the early 80s was not breached for 26 years, and it went down
Okay.
60% in the middle. Again,
Uh,
in 2012-13, the high reached, it was not breached for 8 years, it went down 40% in the middle. So 60% then,
mm.
40% here. So it is not a safe asset. For Indians, what gold did was it provided a currency hedge. And I think that's part of the reason why it looked good to Indians and why Indians have this fascination for gold. But now you have a capital account convertibility to a reasonable degree and you can invest directly globally. So while gold should
Right.
be some part of your asset allocation, it should not be a very substantial part. That would be my advice.
Right. In fact, anything on crude outlook, Devina?
Yeah, crude also, as I said, right now our systems are showing kind of range bound, little bit of
Range bound.
upside bias, but nothing very substantial either way. It's not like a very compelling argument that it's going to rally hugely or crash.
Okay. So no, I mean we have some we have some problems around the Red Sea area which may cause uh, uh, temporary disruptions in crude, but nothing more than that. That's what you're saying.
Yeah.
Great, no problem. And in the meantime, finally, I think we have an interesting question here, and you've shared an interesting article on the books that you read recently. And what are your recommendations for the year 24, incidentally? And you're also working on your own book. Any sneak peek which you could give it to our viewers?
Yeah, so my book is about, this has been a passion for me to learn more and more about investing. And as I said, the most fascinating part of my career is that uh, there's no way you will ever know it all because this is inherently
Okay.
unknowable. So, I mean, you go deeper
Mm,
and deeper and deeper. So, all that I have learned over the years, and I have been a first principles thinker. So, I have challenged everything
mm,
from efficient market theory onwards, and I have devised ratio. So this is a book which is
mm,
actually encapsulating all that I have thought about over the years. Like, for example, should you invest in your circle of competence, which is like
okay.
taken as a gospel by a lot of people? Or
Mm,
should you follow successful investors and what they did, like what Warren Buffett did or what Rakesh Chichudwala did? So many,
right.
it's more thought pieces like that. And it is like my instinct always is that first you're happy, wow, I mean, I understood something. And the other is that let me tell somebody else also that isn't it wonderful? Have you
Mm,
looked at it this way? And I think that teaching instinct comes from my parents who were both academics.
ah,
So in some way, that research and teaching both have in different ways come in my personality. So a book you can say is
ah,
something on that side. And as far as reading is concerned, I am a fairly eclectic reader. So it's not just business and investing. So I mean, for people looking for what to read, my last 2 3 years. I think since 2020 or something, I have been putting out the list
yeah,
of what I like during the year. So that's all there on
right,
my
right.
social media. So that those would be good places to start. And
Yeah.
also, I mean, you must, of course, know the fundamentals. But the thing which has fascinated me in recent years has been all the
Mm,
fallacies of thinking and biases and the of
mm,
where your own mind or your own judgment trips you up and how to
true,
get out of
true.
that, which is why we went into this artificial intelligence and machine learning system. Because
Mm,
once you
mm,
understand that, you understand that there's no way that human beings can get out of all those biases and random noise. Even Daniel Kahneman, who's won a Nobel Prize on his work on
yeah.
this, says that his own decision
Mm.
making has not really evolved just by
Uh,
understanding it intellectually. So
true, true, true. No, no, absolutely. And I'm sure it's going to be an interesting one. We wish you all the very best. And on
thank you.
that interesting note, thank you so much for your time, Devina. That's all for now. But do say log on to ETMarkets live stream for more investment and trading ideas. Thank you so much for your time.
Thanks, Shitish. Lovely speaking with you.
Thanks.